Hey everyone, welcome back to Simone Invests. Today I want to talk about my 5 favourite dividend stocks, the ones I personally hold and the ones that continue to shape my long-term dividend strategy. These companies share a few key traits: stability, reliable cash flow, and a strong commitment to returning value to its customers. Hi, for those of you new here, I'm Simone. I'm no financial expert. I'm just an ordinary person who's been investing in the property market since 2005 and the stock market since 2014. My aim for this channel is to document my journey, and hopefully you'll join me along the way, because the biggest risk you take is not investing at all. As always, this isn't financial advice. This is for inspirational and entertainment purposes only. You should do your own research, as investing does carry risk. So let's get into it. First up is Rio Tinto. What makes Rio Tinto appealing is its role as one of the most efficient miners of essential commodities, that being iron ore, aluminium, copper, and lithium. These minerals underpin everything from construction to infrastructure to the energy transition. But the real attraction, Rio Tinto is a cash-generating machine. When commodity prices are strong, Rio Tinto often returns huge amounts of capital to shareholders through dividends and special dividends. Even in weaker years, its balance sheet strength allows it to maintain respectable payouts. What I like most is the financial discipline. They avoid unnecessary debt, they focus on high-quality assets, and they have a long track record of sharing profits directly with shareholders. For income investors, that combination, scale, discipline, and essential products, makes Rio Tinto incredibly compelling. Recently, Rio Tinto was in high-level negotiation with Glencore about a potential merger, a deal that could have created the world's largest mining company. It would have combined two giants of the commodity world, giving massive exposure to copper, iron ore, aluminium, and other essential metals. But as of early 2026, those talks have collapsed. Both companies walked away due to disagreements on valuation, ownership structure, and overall deal complexity. The scale of the merger would have brought huge regulatory challenges as well. So ending talks removed a huge cloud of uncertainty for investors. So what does that mean for dividend investors like us? For one, Rio Tinto can now return to focus on what it does best: running a lean business, generating strong free cash flow, and returning a significant portion of that to shareholders. The company has repeatedly exercised capital discipline, avoiding unnecessary debt and focusing on high-quality mining assets. With the merger off the table, management isn't distracted by integration risks or multi-year uncertainty. That generally supports more predictable dividend payouts, less risk to cash flow allocation, and a clearer long-term strategy on core commodities. In short, the failed merger isn't a setback for shareholders. It's actually a sign that the company is staying focused on its fundamentals. For dividend investors, that stability is exactly what we look for. I own almost 18 shares of Rio Tinto stock in my Trading 212 stock ISA. There's a link in the description below if you want to open your account and start investing today. You only need £1 to open the account, and if you do, they reward us both with a free share worth up to £100. My Rio Tinto shares are valued at £1,226.23, and they are up 39%. I also have 8 more shares in a general investing account with Hargreaves Lansdown, which are currently being transferred to Trading 212. Rio pay a dividend yield of 4.16%, and my yield on cost, however, is 5.8%. This shows how dividend income grows over time relative to what you paid. Next is Legal & General, one of the UK's most dependable dividend payers. Legal & General operates in the life insurance, asset management, pensions, and retirement solutions, all sectors that benefit from long-term demographic trends. But the true strength lies in its consistent revenue model. Here's why I like it. It produces highly predictable cash flows. It has an established history of consistent dividend growth. It benefits from long-term obligations like pensions that create recurring income, and it's built on a conservative risk culture. Legal & General doesn't try to be flashy. It's steady, dependable, and intentional. The kind of company an investor can rely on for income year after year. To me, it represents the slow, steady heartbeat of a dividend portfolio. I own nearly 502 shares of Legal & General. The shares are valued at £1,341.29 and are up 12.9%. They pay a dividend yield of 8.4%, and my yield on cost is 9.1%. If you're enjoying this breakdown, make sure to subscribe, and let me know in the comments, which dividend stock do you rely on the most? Number 3 is British American Tobacco, a company that often sparks debate, but from a cash flow perspective, it's hard to ignore. BATS generates enormous free cash flow because its products maintain strong pricing power. Its margins are exceptionally high, its customer base is remarkably stable, and it's transitioning into next generation products like vaping and reduced risk nicotine. Now, tobacco is undeniably a declining industry, but BATS operates in a sector where the decline is gradual and predictable. This gives them time to adapt, and in the meantime, shareholders benefit from one of the strongest dividends in the UK FTSE 100. It's not a growth stock, it's not a trendy stock, but it's a reliable, cash-rich business that supports a very generous dividend. And that's exactly why it's in my list. I own 36 shares of BATS, and it's currently the largest holding in my portfolio at £1,679.58, although the others aren't that far behind. The stocks are up 52%, the yield is 5.21%, but my yield on cost is 7.9%. Fourth is the Vanguard FTSE High Dividend Yield UCITS ETF, or much easier to say, VHYL. VHYL is a globally diversified high dividend ETF that holds over 2,200 individual stocks from companies around the world, including Japan, US, UK, Switzerland, Canada, and others. It tracks the FTSE All World High Dividend Yield Index, which means it focuses on companies with strong dividend yields across developed and emerging markets. While individual companies can face challenges, a fund like VHYL spreads risk across hundreds of international dividend payers. It gives me instant diversification, exposure to high-quality global companies, a stable, attractive dividend yield, and lower volatility compared to picking individual stocks. The beauty of VHYL is that it takes out the guesswork. You don't need to analyze every sector or every company. You simply hold a basket of established payers across multiple regions. It's the purest form of set it and let it compound. I own 23 shares valued at £1,499. The shares are up 19.52% and the yield is 3.1%. My yield on cost is also 3.1%. And finally, we have Realty Income, famously branded as the monthly dividend company. Realty Income is a REIT, a real estate investment trust that owns thousands of commercial properties across the US and Europe. Their tenants include large, stable businesses like pharmacies, supermarkets, convenience stores, and logistic companies. Companies like Dollar General, Walgreens, and FedEx. What makes Realty Income special? Well, it pays monthly dividends for a start, not quarterly like most of the other companies. It has raised its dividend over 100 times. Its leases are long-term, predictable, and inflation-linked, and its occupancy rate is consistently above 98%. Realty Income's entire business model is around providing consistent growing income to shareholders. For long-term dividend investors, it's one of the most trusted names in the real estate sector. I own 28 shares of Realty at a value of £1,302. The stock is up just 2%, but was recently in the red for a long while, sitting at around minus 5%. So it's back on the way up. But I still like Realty because of those consistent dividends that keep coming in month after month. The yield is 5.11% and my yield on costs is 5.5%. So those are my 5 favorite dividend stocks. The ones I personally rely on for long-term growing passive income. Each one offers something different. Rio Tinto gives me commodity exposure and massive cash generation. Legal & General provides consistency and dividend growth. British American Tobacco delivers high yields backed by strong cash flow. VHYL offers good diversification. And to round it off, Realty Income gives me monthly income and real estate stability. Together, they form a balanced, income-based foundation that I'm comfortable holding for the long term. And don't forget, if you enjoyed this breakdown, make sure to like, subscribe, and let me know in the comments, what dividend stock do you rely on the most? Thanks for watching, and until next time, take care.